Stop everything. Stop exactly what you are doing right now. Secure your surroundings, silence every distraction, and prepare yourself for the most critical, paradigm-shifting financial intelligence briefing you will ever receive. This is Capital Archives, and what we are broadcasting today is the absolute nightmare scenario that the Western financial establishment, the central banking cartel, and the monolithic bullion banks have spent decades and billions of dollars trying to prevent, obfuscate, and deny. We are not talking about a routine market correction, a hawkish pivot by the Federal Reserve, or a temporary supply chain bottleneck that will be resolved in the next fiscal quarter. We are talking about the catastrophic mathematical and physical failure of the primary pricing mechanism for the most critical industrial and monetary metal on planet Earth, and the terrifying realization by one of the largest financial institutions in the world that they are caught on the wrong side of history. The rumors that have been echoing through the dark, highly restricted corridors of the commodities markets, the whispered panics in the over-the-counter derivative desk have finally materialized into a terrifying reality. We have uncovered the architecture of the final endgame, and it centers around a specific hyper-calculated and deeply concealed internal metric, the $309 price target. This is not a number pulled from the digital ether by retail speculators or internet permables. This $309 target is the internal damage assessment, the worst-case scenario modeling, and the ultimate destination that institutions like Bank of America are now secretly preparing for as the global paper silver market faces total, unmitigated annihilation. If you hold paper silver, if you rely on silver for industrial manufacturing, or if you simply hold your wealth in a fiat currency backed by nothing but the eroding faith and credit of indebted governments, you are currently standing on the tracks of a runaway freight train. The disconnect between the synthetic paper market and the hard, undeniable physical reality is finally snapped, and the shockwave is about to vaporize trillions of dollars of illusory paper wealth while simultaneously launching the physical asset into the stratosphere. To comprehend the sheer magnitude and gravity of a $309 silver price, and why a colossal entity like Bank of America would be modeling for such an explosive systemic reset, you must first completely deconstruct the lies you have been fed about how the precious metals market actually operates. For over half a century, the price of silver has not been determined by the fundamental organic laws of physical supply and physical demand. It has been dictated by a colossal heavily leveraged derivatives casino where massive bullion banks trade digital contracts representing metal that simply does not exist in the physical realm. This is the ultimate fractional reserve shell game, a masterpiece of financial engineering designed to siphon wealth from the physical producer and hand it to the paper speculator. For every single ounce of actual physical silver sitting in a registered COMEX vault or a London Bullion Market Association depository, there are upwards of 100 to 300 paper claims floating around in the digital ether. These institutions, historically led by the massive trading desks of Wall Street behemoths, sell immense quantities of paper silver into the futures market to artificially suppress the price, knowing that historically 99% of speculators are perfectly happy to roll their contracts over or settle their bets in depreciating fiat cash. They never actually ask for the physical metal. The entire system is predicated on the psychological conditioning of the market participants to accept fiat currency instead of the physical asset. But within this matrix of manipulation, massive structural imbalances have been building, and Bank of America has found itself holding what is arguably the most toxic, explosive derivative book in the history of the commodities market. The origins of this specific institutional panic trace back to the deeply opaque mechanics of bullion leasing. You see, major banks do not just short the market by writing naked futures contracts. They engage in complex leasing arrangements to acquire physical metal, sell it into the market to crush the price, and promise to return it at a later date. Years ago, as the industrial demand for silver began to quietly accelerate, a massive leasing operation was executed. Billions of ounces of silver were leased, theoretically sourced from the massive exchange-traded funds and major depositories, and dumped into the physical market to satisfy the relentless Eastern demand and keep the price artificially tethered to the $20 range. The institution executing this trade, widely understood in the deepest echelons of the wholesale market to be driven by the colossal derivative books of Bank of America, assumed they could eventually buy the silver back at a lower price to close out the lease. It is the classic short seller strategy, sell high, buy low, pocket the difference. But they miscalculated. They fundamentally misunderstood the nature of the modern global economy. They assumed silver was still just a speculative monetary token, a shiny rock that could be manipulated with paper algorithms. They failed to realize that silver had transformed into the indispensable, irreplaceable bedrock of the 21st century technological empire. Now, the metal is gone. It has been consumed by solar panels, locked inside electric vehicles, and hoarded by Eastern central banks. The massive short position, the colossal obligation to return hundreds of millions of ounces of physical silver, is a ticking time bomb on the bank's balance sheet, and the $309 price target is the mathematical projection of what happens when that bomb detonates. Let us dissect the mathematics of this $309 target, because it is not arbitrary. It is a reflection of profound geological, historical, and financial convergence. Firstly, we must look at the historical monetary ratio. For thousands of years, the natural economic equilibrium between gold and silver hovered around 15 to 1. This means it took 15 ounces of silver to purchase 1 ounce of gold, a ratio roughly reflective of their relative abundance in the Earth's crust. Under the current regime of paper manipulation, that ratio has been violently distorted, often blowing out to 80 or 90 to 1. But nature always forces a reversion to the mean. If gold, acting as the ultimate sovereign wealth reserve in a world of collapsing fiat currencies, ascends to $4,600 an ounce, A highly conservative target given the unprecedented expansion of the global M2 money supply. A reversion to the historical 15 to 1 ratio mathematically places silver at exactly $306 to $309 per ounce. But the modeling goes deeper than just historical ratios. The $309 figure also represents the exact inflection point where the paper derivative leverage completely breaks down. If the open interest in the silver futures market represents roughly 300 paper claims for every 1 physical ounce available for delivery, the unraveling of that leverage requires the price to multiply exponentially to balance the equation. When the bullion banks are forced into the open market to buy physical silver to cover their lease deficits, they will discover a liquidity vacuum. There are no sellers at $30. There are no sellers at $50. The algorithmic models run by the risk management departments of these megabanks show that to coax enough physical silver out of private hoarding and industrial scrap to satisfy the massive short covering rally, the price must gap up violently, bypassing all technical resistance levels until it hits the terminal velocity of $309. This catastrophic squeeze is not a theory. It is being actively triggered right now by an industrial demand curve that can only be described as an inelastic, ravenous black hole, completely oblivious to the paper games played in New York and London. We are no longer living in an era where silver is primarily used for silverware and photographic film, where demand could ebb and flow with consumer discretionary spending. We are in the midst of the most aggressive, resource-intensive technological revolution in human history, and silver is the absolute, uncompromising bottleneck. Let us look at the photovoltaic sector, the vanguard of the global green energy transition. The worldwide mandate to transition away from fossil fuels has triggered the deployment of hundreds of millions of solar panels. But the industry has evolved. It has transitioned from older, less efficient technologies to top-econ and heterojunction cell architectures. These advanced designs are significantly more efficient at capturing solar radiation, but they demand massive, fundamentally irreplaceable amounts of silver paste. The solar industry alone is currently on track to consume nearly 250 million ounces of silver this year, wiping out roughly 30% of total global mine production. And here is the terrifying reality for the short sellers at Bank of America. A massive Chinese solar manufacturer cannot run their assembly lines on paper futures contracts. They cannot manufacture a high-efficiency energy grid using digital bank ledgers. If the price of silver triples, they will not stop buying it. They will simply pay the premium and pass the cost onto the consumer. Because without the physical atoms of silver, they have absolutely no product. Their demand is entirely price inelastic. When the bullion banks attempt to cover their shorts, they are stepping into the arena against industrial titans who will pay any price to survive. Simultaneously, the artificial intelligence arms race has triggered a massive global expansion of hyperscale data centers. We are witnessing the construction of facilities that consume more electricity than small cities, housing incredibly powerful microprocessors and server racks that generate immense amounts of thermal energy. Silver, being the most thermally and electrically conductive element in the known universe, is absolutely critical for the specialized solders, high-speed microswitches, and complex cooling matrices required to keep these AI systems from literally melting down and catching fire. You cannot run the economy of the future on copper. It suffers from thermal diffusion and signal latency. Add to this the explosive government-mandated growth of battery electric vehicles, which require 3 times the amount of silver as traditional internal combustion engine vehicles, and the relentless classified demand from the global military-industrial complex for precision-guided munitions, satellite communications, and drone warfare systems. Every single Tomahawk missile, every advanced fighter jet, every surveillance satellite contains vital silver components that are destroyed upon use, permanently removing that metal from the global supply chain. This multi-front industrial assault on the physical silver supply cannot be destroyed by higher paper prices or exchange margin hikes. The COMEX and the megabanks are fighting a war of attrition against the physical laws of metallurgy and global industrial expansion, and it is a war they are mathematically guaranteed to lose. The $309 target is the price at which the industrial sector finally forces the financial sector to capitulate. The inevitability of this massive price reset is further cemented by a geological reality that mainstream financial analysts, sitting in their glass towers in Manhattan, completely ignore or utterly fail to understand. The common, deeply flawed assumption in classical Keynesian economics is that the cure for high prices is high prices, meaning if the price of silver skyrockets due to a massive short squeeze, mining companies will simply ramp up their operations, flood the market with newly extracted supply, and quickly stabilize the system. This assumption demonstrates a fatal, almost comedic ignorance of geological extraction and metallurgical science. Silver is a geological ghost. It does not exist in massive, easily accessible standalone veins like it did a century ago. Today, over 70% of all the silver mined on planet Earth is not extracted from primary silver mines. It is a byproduct of mining for industrial-based metals like zinc, lead, and copper. You cannot simply command a copper mine operator in Chile to double their silver production to alleviate a squeeze in London. To get more silver, they would have to drastically increase their copper extraction, which would flood the global copper market, crash the price of copper, and bankrupt their entire multi-billion-dollar operation. Therefore, the global supply of newly mined silver is fiercely, immutably inelastic. It does not respond swiftly to price spikes. Furthermore, the global mining sector has suffered from over a decade of severe capital underinvestment, hostile environmental regulations, resource nationalism, and the undeniable reality of rapidly declining ore grades. Miners are digging deeper, utilizing more energy, and moving exponentially more tons of dirt to extract fewer and fewer ounces of metal. We are staring down the precipice of peak silver. a structural, multi-year deficit where the Earth physically cannot yield enough metal to satisfy the ravenous demands of the modern green and digital economy, let alone bail out the massive short positions of the Western banking cartel. No amount of paper contracts or derivative manipulation can alter the geological constraints of the Earth's crust. This internal collapse of the Western paper market and the impending Bank of America margin crisis is occurring exactly at the moment when the geopolitical tectonic plates are violently shifting, accelerating the drain of physical metal from west to east in a coordinated attack on American financial hegemony. We at Capital Archives have meticulously documented the strategy of the BRICS nations, led aggressively by China and Russia, to systematically dismantle the unipolar dominance of the United States dollar. The weaponization of the SWIFT system and the freezing of Russian sovereign reserves sent a chilling, unmistakable message to the capitals of the global south. Your fiat wealth is only yours as long as you comply with Washington's directives. True sovereign wealth, true financial independence, is not held in digital entries on a Western central bank ledger. True wealth is physical mass. It is energy, it is agricultural dominance, and it is tangible, unencumbered precious metals. While the West has been busy trading synthetic silver derivatives and desperately trying to maintain the illusion of a $25 silver price, the East has been quietly, relentlessly accumulating the physical reality. Look at the Shanghai Gold Exchange. The SGE operates on a physical delivery model, a stark contrast to the fractional reserve paper model of the COMEX. For months, the SGE has been trading silver at a massive, persistent premium compared to the Western exchanges. This arbitrage gap acts as a giant global vacuum cleaner. Opportunistic traders acquire the artificially suppressed paper silver in the West, stand for physical delivery, load the metal onto secure cargo planes, and sell it into the voracious Chinese market for an instant risk-free profit. India, a nation with a deep cultural and unshakable affinity for precious metals, recently imported tens of millions of ounces in a single month, further devastating the global above-ground stockpiles. The COMEX is bleeding to death, and the bullion banks are trapped in their leases because the East is calling their bluff. They do not want cash settlements. They want the atoms. The $309 target is the price at which the West runs out of metal to send to the East. So, how does the final squeeze actually unfold? What is the sequence of events that catapults silver from its suppressed paper reality to the $309 physical equilibrium? It begins with a crack in the dam, a moment of realization by one major player that the physical collateral backing the massive derivative structure no longer exists. If a behemoth like Bank of America decides to aggressively cover their short position to buy back the millions of ounces they have leased and sold, they must enter the open market as a buyer. But when an entity of that size begins to buy, they instantly overwhelm the available liquidity. The algorithms detect the massive buying volume and the price begins to spike. The other bullion banks, realizing that the first one to the exit survives and the last one to the exit is annihilated, panic, and begin trying to cover their own massive short positions. This creates a cascading, self-feeding loop of forced buying. But remember, they cannot cover paper shorts with other paper contracts. They must acquire physical metal to return to the entities they leased it from. As the price rips higher, blowing past $40, $50, and $80, the massive hedge funds and institutional speculators who are riding the momentum on the long side begin to demand physical delivery. The COMEX and the LBMA vaults are suddenly hit with delivery requests that far exceed their registered inventories. The exchange is pushed to the absolute brink of systemic default. They raise margin requirements, they halt trading, but the physical buyers, the industrial conglomerates, and the sovereign wealth funds, do not care about exchange rules. They bypass the exchanges entirely and go directly to the refiners and the miners, offering massive premiums. This is the moment of force majeure. The paper exchanges, completely out of metal, declare a delivery failure. They forcefully close out the remaining futures contracts, handing depreciating fiat currency to the holders and telling them the metal is gone. This event destroys the last remaining shreds of faith in Western derivative pricing. It proves to the entire world, unequivocally, that the price of silver on the brokerage screen was a fabricated lie designed to protect a bankrupt system. The psychological contagion resulting from this failure is instantaneous and utterly devastating. The retail public, realizing that their exchange-traded funds are merely unbacked digital IOUs, stampedes into local coin shops and private depositories, desperate to exchange their dying fiat currency for anything tangible. But the shelves are bare. The industrial giants have already secured everything. The physical price, completely unmoored from the collapsed paper market, ascends into the stratosphere, seeking its true, unmanipulated equilibrium based on the desperate bids of industries fighting for survival and central banks fighting for monetary supremacy. The model suggests that this violent, chaotic price discovery mechanism will not stall at $100 or $200. It will overshoot dramatically, driven by panic and an absolute absence of supply, until it hits the terminal velocity calculated by the risk managers, $309 per ounce. This is the ultimate endgame of a financial system that believed it could endlessly print currency, endlessly issue unbacked derivatives, and endlessly manipulate the physical elements of the universe without consequence. The whispered panic regarding the Bank of America short position and the $309 price target is not merely a technical glitch or a routine volatility adjustment. It is the death rattle of the fiat era. It is the violent thrashing of a leviathan that has finally been caught in its own net. It is the moment when the physical reality brutally reasserts its dominance over the financial hallucination. Silver, because of its unique, paradoxical dual role as both an indispensable industrial miracle metal, and a historical monetary safe haven, is the Achilles heel of the entire global debt matrix. By artificially suppressing its price for decades, the financial elite subsidized the technological expansion of the modern world while simultaneously discouraging the capital investment required to actually mine the metal. They created a massive, tightly coiled spring of deferred physical demand, and now that spring is violently releasing, ripping the doors off the COMEX vaults and destroying the balance sheets of the institutions that thought they could control it. The fact that internal models at major banks are projecting these astronomical figures is the ultimate vindication for those who have stood outside the mainstream narrative, demanding physical possession in a world obsessed with digital illusions. The wealth transfer that is about to occur will be of biblical proportions. It will not be a transfer from the poor to the rich, but a transfer from those holding paper promises to those holding tangible, elemental reality. As we stand on the precipice of this historic dislocation, the mission of Capital Archives remains unwavering and absolutely critical. We are here to strip away the propaganda, to expose the fragile mechanics of the financial machinery, and to prepare you for the violent paradigm shift that is now unfolding in real time. The internal panic regarding the $309 target is the ultimate signal fire. It signifies that the era of artificial abundance and manipulated pricing is over permanently. The institutions that have controlled the narrative for a century are losing their grip, trapped in their own leasing schemes, because they have run out of the real money and the real metal. Do not be deceived by the inevitable mainstream media spin that will attempt to portray the coming price explosion as a speculative bubble or a temporary market anomaly. This is a structural, permanent recalibration of value. It is the culmination of decades of financial hubris meeting the unyielding laws of physics and geology. If your wealth is tied up in the paper derivative complex, if you are trusting ETFs, unallocated accounts, or the promises of heavily leveraged banks, you are currently the yield for the entities executing this physical drain. You are the collateral damage in a war between paper and atoms. You must reevaluate your exposure immediately. You must understand that in a world where the primary exchanges will inevitably default, and where major banks are preparing for a tenfold increase in the price of the underlying asset, counterparty risk is the ultimate lethal threat. The physical silver market is breaking free from its paper chains. The Eastern accumulation strategy and the relentless industrial consumption have broken the Western fractional reserve vaults. The institutions are preparing for $309 because they know the silver is gone, the leverage is broken, and the final squeeze has already begun. Prepare yourselves accordingly, take possession of your assets, step outside the digital matrix, because when the world finally wakes up to the fact that the vault is empty and the paper price was a lie, the true price discovery of the most undervalued asset on the planet will commence, and it will be brutal, rapid, and entirely unforgiving.